What's up, investors? It's the Russian dude. Let's talk about the most complicated test for the last several years that the stock market is facing literally in the very near future. And this most complicated test I'm talking about is how it will react because of the decreasing revenues of the magnificent 7 companies in some of the next earnings reports, which can start as early as already the first quarter of 2025, which is very important thing to talk about it since right now we're in the very middle of the second quarter earnings report season. And so yeah, the companies we are going to talk about is this once again Magnificent 7, these companies which are moving the performance of the S&P 500 index, and at this point the entire stock market just by its presence. So just for example, big 5 companies excluding such as Nvidia, because the growth of revenue for Nvidia is in triple digits, so it will skew the data. But if we talk about the big 5 tech companies, it is expected that already in the first quarter of 2025, the revenue growth will slow down from 22% year over year to 17% year over year, and already the next second quarter, it will slow down to 14-15% year over year, which is already more or less aligned with industry's average, which is, let's say so, not acceptable for companies which move the entire indices with them. And the reason why I excluded Nvidia is once again because its revenue growth is in triple digits, which is a mind-blowing numbers they were able to achieve, and well, the stock price reflects it. So long story short, in the first quarter of 2025, the revenue growth will slow down only to 110% year over year, which is still a huge number until you compare it to the previous number, which was 262%. So as you can see, the growth slowed down more than twice. And here is a big problem. As you can see, the revenue growth of every single big 7 tech companies is expected to slow down, while the rest 493 companies within the S&P 500 index, their revenue on average is expected to increase going from quarter to quarter for the next year, specifically in the second quarter. The revenue increase is expected to be at approximately 3%, and then the next, third and fourth quarter, this growth is already expected to be at plus 5%. A small increase, but increase nonetheless. And most likely the reason for this happening, I'm talking about the reason why the big 7 revenue growth is expected to slow down. It is because we are about to enter the cycle of interest rate cuts. So basically what it means, this is the attempt of the Federal Reserve to increase the economical activity within the country. And so yes, rightfully the stock market reacts by majority of companies increasing their output, which is completely the opposite from what is expected from big 7 companies. When the economic activity supposedly needs to increase, their output decreases. Besides this, some financial multipliers, they show us that these 7 companies are significantly already overvalued in comparison to the rest of the stock market. For example, EV sales of those big 7 tech is approximately 8, while the rest of the stock market is approximately near 3. And why specifically this matters, it is because historically, companies with this particular EV to sales multiplier, if they were way above industry average, eventually they were inevitably correcting themselves. They were not able to maintain such high standards, such high growth rates. For this reason, the other institutional investors, financial companies, they were revising their expectations to more negative. And another financial multiplier which shows that these companies are pretty overvalued, to say the least, is the forward PE ratio. For example, it goes as following: Microsoft of 33, Apple 29, Nvidia 34, with the highest being Tesla of 58. Just as a reference, the normal forward PE ratio is considered to be anywhere between 15 and 20, no more than this. And so, the rest of the stock market forward PE ratio on average is approximately 18, and if we only take small cap companies, it equals 14, which is even a little bit below what it should be, which means that these small cap companies are a little bit even undervalued, and small caps are a very important thing for today's video. Later I will talk a little bit more in details why is it so. Another very unusual graph which shows that right now the biggest companies of the US stock market are overvalued is this graph which shows Dow Jones Industrial Average Index in gold terms. Just like me, probably you're seeing this graph for the very first time, you didn't even know about its existence, but well, here it is. And it shows that right now the value of the Dow Jones Index is in its very overvalued territory. It's literally bouncing across this resistance level. Well, if it's not able to breach it, which most likely it won't, because we are due to a small correction, the only way forward from there is going down. Next, we also see the graph which shows the correlation between growth stocks and value stocks, and well, as you can see, it reached such big levels like we've never seen before, all the way until .com crash bubble. And this basically means that the growth stocks are significantly overvalued in relationship to the value stocks. Guess what? Every single one of these magnificent 7 companies are considered to be growth stocks. And since we did talk about small caps, so well, here is a little bit more details about these particular companies. So you know there is this particular index which tracks the smallest 2000 companies and is called Russell 2000. Well, apparently it significantly started outperforming the rest of the stock market, specifically Dow Jones and S&P 500 indices. And well, yes, we did talk about this particular investment in small cap companies. In one of my previous videos, I did mention that right now they do look extremely undervalued, they do look extremely attractive in comparison to the rest of these huge, massive companies. And well, right now the market finally starts to catch up on this idea as well. Specifically in the last 5 days, Russell 2000 index gained 7.43%, which is a massive number for the entire index for such a short period of time, and in comparison the S&P 500 only gained 0.84% in the same period. And the reason why these small cap companies are so undervalued and overseen, it is because, yes, the entire performance of the S&P 500 index and at this point the stock market itself was mainly dragged because of these magnificent 7 or top 10 companies. These companies were going up despite whatever earnings they were producing. People were buying, specifically Nvidia, which boosted the performance of the index a lot. And other companies, the rest of 493 companies within the S&P 500, they in fact were already correcting themselves. The correction started within most of the stock market, the correction that us, retail investors, we simply could not see, because once again, the performance of the S&P 500 was boosted by only 10 to 15 companies. And well, whenever these small caps are being now extremely oversold and the financial multipliers become extremely attractive, well, now the cycle reverses, and this is when people start buying such companies. Well, the results, they speak for themselves. Another thing, whenever people are uncertain about the performance of their best gainers and best industry-leading companies, another thing where people can invest their money are commodities. And well, this next graph shows that people started actually to invest in commodities, even though the increase is very small at this very moment, so we still yet to see a big wealth transfer from securities into commodities, potentially, in the near future. And all of these troubles that the stock market might face in the near future, as soon as earnings reports of big 10 companies, they stop being so attractive. Well, another thing that adds to the badness of this whole situation is that the consumer confidence, according to this next graph, some people call it consumer sentiment, it's more or less the same thing. Well, it is in its minimum levels for the last 8 years. And so as a result, what we might see in the beginning of the next year, this big challenge that the stock market is facing right now, is that big companies will be showing not that attractive earnings reports, the revenues will start to decline, so most likely the share prices will start going down and they will be dragging the entire indices and the whole stock market with them, despite the fact that 95% of the rest of the stock market might still be in the green zone. And once overall panic takes place, once people start selling small caps as well, this is when we might see a correction which is long overdue, or maybe something even scarier. And so the main question of the video is the following: is the market ready for this tough challenge it is facing, how it will respond, and are we gonna see the correction or will there be more? And traditionally we end this video with the earnings reports of this week, so feel free to pause the video to see if your company is reporting. And as always, thank you so much for watching. Please like this video and subscribe to my channel if this was interesting, informative, or both, and see you tomorrow.